Consumer spending intentions are central to understanding how the Australian economy is performing. CommBank's Household Spending Intentions Index, or HSI Index, provides a unique and forward-looking insight into consumer spending patterns. The HSI Index is based on CommBank's transactional data set, the largest in Australia, covering 2.5 million Australian households and approximately 40% of consumer payment transactions. It uses advanced analytics to overlay Google Trends' publicly available search activity, a guide to people's likely spending intentions. The CommBank HSI Index is based on 12 different spending categories. This covers the majority of household expenditure, producing a single leading indicator, providing a more complete view of Australia's spending intentions. Look further ahead with data-driven insights into consumer spending. Learn more at commbank.com.au/HSI.
Good morning, everybody. My name's Andrew Hinchliffe. I'm the Group Executive for Institutional Banking and Markets, and welcome to the launch of our new Household Spending Intentions Index today. Before we start, I'd like to acknowledge the traditional owners of the land in which we meet today, the Gadigal people of the Eora Nation, and pay my respects to elders past, present and emerging. The value of robust and reliable data has long been well understood, in particular by banks, governments and organisations. I think this was even more profound during the crisis, where the value of real-time data really helped businesses and key leaders across the economy make decisions and understand what was happening in the economy. And we think this is going to be even more important going forward to help in Australia's recovery and transition. Now, as Australia's largest bank, we've got the largest transaction data set in the country. We see 40% of every payment through the economy. And with such a valuable data asset, it's important that we continue to invest in the analytical capabilities and the data asset itself to improve the products and services that are important for our customers and our key stakeholders. This is evident through our recent investment in H2O, also evident through the recent JV we announced around CommBank IQ, where we matched the analytics capabilities of Quantium, Australia's leading data analytics company, with our critical data asset to provide really unique insights into our institutional banking clients. And equally today, the new Household Spending Intentions Index is an iteration on the previous version, which we think is going to set us up to provide more meaningful insights and in fact leading insights across the economy to all of the key stakeholders and leaders that are going to make the decisions that are going to drive us on to future prosperity. Now, to do that, I'm going to pass over to our Chief Economist, Stephen Halmarick, who's going to walk you through the various aspects of the new index. And then I'm going to hand over to Belinda Allen, our Senior Economist, who's going to walk through the October results for the new index and talk about what insights it shows us into the economy. Stephen, over to you.
Well, thanks very much, Andrew. I really appreciate that. And yes, we're very excited in the research team at CommBank to launch the Household Spending Intentions Index today. It's been a lot of work to get to this point, so I'm going to provide a bit of a timeline into the development of the Household Spending Intentions Index and the key features of the index, and then I'll hand over to Belinda Allen, who will run through the outcomes for October. So we actually started the Household Spending Intentions series in July 2019, and we had 7 spending categories. So home buying, retail, motor vehicles, entertainment, travel, education, health and fitness. And that covered about 55% of consumer spending. So we used the internally generated transaction data at Commonwealth Bank, credit and debit card spending, other payment options like BPay and direct debit, CBA lending, and then we add to that the Google search terms. And so Google search terms give us the indication of what people intend to spend money on. So with the launch today of the Household Spending Intentions Index, we've added 5 new spending categories, so there's now 12 altogether. So we've added on transport, insurance costs, utilities, communications and digital, and household services. Together, these 12 spending categories cover the vast majority of spending by households in Australia. So really great coverage. And more importantly, or as importantly, we've now combined all those into one single index. So each of the 12 components of spending categories will have their own index. We combine that into the HSI Index. So every month we will publish the index number, the monthly change and the annual change. It's based on July 2017 at 100, and we'll be able to gauge changes in the index as time goes by. So we have found that this, by virtue of the size of our data set, so as Andrew mentioned, it's 2.5 million households, 40% of consumer transactions. It does give a really great insight into the economy and has a much broader reach than other consumer sentiment surveys that you might see out there. The Google search terms add about a 15% improvement into the model's predictability. So it's really adds a very important element. We use the Google search terms with about a 1-month lag between searching and actual activity. So all in all, the key features of the HSI Index are 12 spending categories. They're weighted by household consumption, provides that really key single indicator on household spending intentions. It uses that very large data set that we have at Commonwealth Bank. And as I mentioned, each of the 12 subcomponents will have their own index as well. So in time, we see the HSI Index becoming a really key monthly data point for the Australian financial markets, for those that look at the economy, for policymakers, for investors, for businesses, for the media. And we think over time, as I mentioned, will become a real key indicator for Australia. The really important feature, of course, is actually, does it tell us something about what's happening in the economy? And the answer there is yes, it does. Because, again, of the very large size of our data set, we can measure the HSI Index versus the household final consumption measure in the national accounts. So, of course, that's a quarterly measure, and we've looked at data from the third quarter 2018 to the second quarter this year. And if we can see on the chart here, the correlation is very high. It's around 0.9%. So the HSI Index is telling us what the national accounts household final consumption number, the annual percent change, the correlation is very high. The caveat there is it's a pretty short period of time, and of course for a large amount of that time we've been in COVID, so you can see here the volatility's been quite high on the actual numbers and the index, but correlation again is very high. We can break that down to some of the individual components. So on the left here we have the retail trade number from the Australian Bureau of Statistics and the HSI Index on retail trade. Again, you can see very strong correlation. Similarly with health spending and the transport numbers. So we're pretty confident that the HSI Index numbers are going to give us a really good lead on the official ABS data as that is released. So just the highlight before I hand over to Belinda. So the outcome for October this year was the index is sitting at 108.0. So that's a 6.6% increase on the month. It's up 4.4% on the year. You can see from the chart really quite a strong increase from the reductions in the index through the lockdown period. Now the key drivers of that improvement in October were travel, transport and household services, many of those bouncing off some pretty low levels. The home buying index was actually down a little bit over the month, but certainly the reopening of New South Wales and Victoria, travel, transport, household services, the key driver. So I'm going to hand over now to Belinda, and she's going to run through the individual components of the index on the month. So Belinda, over to you.
Great, thank you, Stephen, and thank you, Andrew. So as we can see, the CommBank HSI Index did rise in October, and so what I'm going to do now is to go through those individual 12 spending categories, talk about how they performed in October, and also what are some of the key components that saw those changes as well. So we have to think about the context. In terms of October, we did see the New South Wales economy begin to reopen earlier in the month. ACT and Victoria did begin to reopen as well, and those reopenings were quite flagged as well. So some of the key themes that we've seen in the individual HSI components is an easing of restrictions, did see Australian consumers increase their spending, on certain categories that they haven't been able to spend money on in the past. So that's where Stephen highlighted that we did see an increase in travel. That particular index jumped over 50% on the month and is up around 13.5% on a year ago levels. The same can be said for transport. So that's more people moving about, going to work, visiting family, things like that. So toll roads, fuel, things like that. So the transport index jumped by about 20% in the month, but it still remains well below on year ago levels. Some of the other key thematics that we did see was that reopening of the economy. So we did see the retail spending intentions index rise at quite a large 9% in October. As I said, that was really driven by the reopening of large parts of the Australian economy, particularly on the East Coast, and a lot of pent-up demand coming through there, and also I think a lot of accumulated household savings. We also saw that same thematic impact on entertainment spending intentions. So that was up a strong 14.7% in October. But once again, that does remain below year ago levels. So that index is still down 7.2% on the same number in October 2020. Some of the other categories in particular, there's always a lot of interest in the home buying component. So that was down by 1.4% on the month, but is still well up on 12.4% compared to a year ago. And I'll show you some charts on these key indexes in a minute, which really gives you a flavour about how each has performed since the inception back in July 2017. We did see motor vehicle spending index was 1% lower in the month, and we do think that is firmly reflecting a lot of supply side constraints we're seeing in getting cars into the Australian economy at the moment. We did know that car imports were down heavily in September because of those supply side constraints. But really demand for cars is up still a very strong 31.9% compared to a year ago levels. Some of the other components, in particular education spending intentions, were largely unchanged on the month, but is still up around 2.1% on year ago levels. Same as health and fitness, only a small increase on the month, up just 1% in October. Insurance spending intentions, so one of those new categories that we did introduce, was down 0.7% in October and is up 1.8% on the year. Utilities is another new category, so that was lower by 0.7% in the month and is still up only about 0.7% on the year. And finally, the two other new spending categories, communications and digital spending, that was little change in October and just a touch higher on an annual basis as well. And household services, so this is once again a new category, so it includes things like childcare, cleaning services, anyone coming to your house to do home improvement services. That rose a very strong 24.1% in October as restrictions were eased. We're obviously very keen to get a lot of people to come back in and help us out, and is now back above levels of a year ago. So we can see some of the really interesting trends in these individual spending components as we look at the charts. So just looking at home buying in that first chart on the left-hand side. So as I said, that did fall in the month, but as you can see, it's still up strongly from year ago levels, so up 12.4% on the year. So if we look at what happened in October, we did see home loan applications still rising, but Google searches for property and inspections and appraisals were down as well. And so this is one of the components we're watching very closely at the moment. There's obviously a lot of interest in the housing market with changes from the regulator in terms of the interest rate serviceability buffer. We have seen a lot of strength in the housing market in 2021, so we're watching that index very closely. The retail individual component as well, we can see that did lift very sharply in October. As we said, because those restrictions did ease, we did see a lot of people able to go out and shop in bricks and mortar again. Online has been very strong throughout the pandemic, but we did see a lift, particularly in October in specialty stores, department stores, furniture and appliances, and clothing as well. So probably those items that may not have been wanting to be purchased online, we did see a lift as restrictions were eased. What's really interesting though is if we look at where the weaknesses are, it's still very much in items such as duty-free and arts and craft as well. So maybe people doing less at home as people pivot as restrictions ease to get back out of the house again. Motor vehicles is a really interesting one. As we said, a lot of supply side constraints starting to impact that individual category there. So we did see motor vehicle spending intentions fall by 1% on the month, but still up a very strong 31.9% on the year. So we have seen a lift in demand for cars, particularly maybe people being less happy to catch public transport, wanted that second car at home. So we have seen spending intentions continue to be very strong over the past year in terms of motor vehicles. So in October, we did see a fall in actual spend, but loan applications do continue to rise. Moving on to entertainment, you can see there that the individual spending HSI for entertainment has really picked up with that big fall back in 2020 due to the national lockdown. It has been quite volatile since, just because of restrictions. We did see it lift 14.7% in the month. And the biggest drivers of that lift was people eating outside the home. So people looking forward to eating out at restaurants as restrictions were eased. I think we all got to be sick and tired of cooking at home, so we're very happy to get out and about again. And also as live theatre and movie theatres came back, so we did see a lift in spending on those items as more shows come back as restrictions have eased. We still do see some weakness in some particular categories in entertainment, so books and bowling alleys were weak in the month, obviously happier to do different things. If we move on to some of the other categories, once again, travel has been one that you can just see the impact from border restrictions, both the international border restrictions and the state border restrictions. We saw travel HSI plummet during the national lockdown in 2020. We did see some recovery as restrictions were eased at the end of last year and into the early stages of 2021 before the lockdowns, particularly on the East Coast. But the good news is we did see a lift, as I said earlier, by 52.7% on the month. And it's really interesting. We're starting to see a pivot in what those travel spending is being done on. So in the month, we did see a lift in spending on airlines and travel agents from a very low base, whereas earlier we had seen a lot of spending on things like motorhomes and caravan parks. So a bit of a pivot going on in terms of that travel spending intentions. The next one is that education component, obviously less volatile than what we see in travel and retail, but we did see travel spending remain largely unchanged in the month, but is still up around 2.1% on the year. So we did see spending little changed, but Google searches up in that particular category. Now, health and fitness, we did see that plummet during the lockdown as well. As gyms were closed, people didn't go out and get that medical care and visit their doctor as much, but we are seeing a recovery in that category. So that lifted by 1% in the month and is up around 10% on the year. So actual spending was up. Google searches were up as well, and we did see in that October reading more spending on doctors, beauty, bikes and golf has been extremely popular over the past 12 months. If we look at that individual category in particular, one of the largest lift has been spending on public golf courses, and that's because they largely remained open during the whole of the pandemic. Insurance cost is one of those new categories, so we can see that. Once again, that category is less volatile than some of those other categories. It's up around 1.8% on the year. And moving on to some of those other categories, transport, once again, you can see just the impact during the pandemic. Work from home restrictions have certainly seen people's mobility reduce a lot less spending on items such as fuel, tolls, even getting your car washed, but we are seeing some signs that that is starting to change. So transport spending was up by 20.7% on the month. It's still only up around it's down 1.45% on the year. So during October, we spent more on fuel, on taxis, so really reflecting the increase in mobility, car washes and towing. But what is still low over the past 12 months is on commuter services, so rail, ferry, buses, so people not moving about as much. Obviously, that's the work from home restrictions still coming through. Less on tolls and less on car rentals, which really reflects less people travelling about. Utilities, one of the new categories, once again, very important part of the consumer spending basket, but a lot less volatile than some of those other categories. So that was down 0.7% for the month, but up 0.7% for the year. We saw Google searches up, but actual spending down. Then communications and digital, once again, one of those new categories that we have introduced. That was down just for the month by 0.3% and up 0.4% for the year. So we did see a lift in spending on computer software, pay TV, digital spending, but less spending on telecommunications. And then finally, household services. So once again, one of those categories that has really been impacted by restrictions during the COVID-19 pandemic, but with the reopening of large parts of the Australian economy, easing of restrictions, we did see a lift of 24.1% for the month, and it's now up 5.5% for the year. So we saw a lift in both actual spend, but Google searches as well. And with an easing of restrictions, we saw a huge lift in spending at beauty salons, but also we saw a lift in spending at vets as well. Whereas we did see falls in spending on childcare, electrical contractors, landscaping and carpentry as well. So a real pivot as to what people are spending money on in those particular categories. So I think a few key thematics coming through: supply chain disruptions in terms of motor vehicles, but really with the easing of restrictions coming through the Australian economy, we've certainly seen a lot of pent-up demand, and we're seeing consumers come out there and spend. So we're just leaving here. You can see these are the 12 major spending categories for the HSI. We've just broken up here what each individual spending category does contain, so you can get a better flavour of just some of the moving parts in the new and enhanced HSI.
Fantastic. Thanks, Belinda. It's a really thorough review of the outcomes for October, so really appreciate that. And I think now, Andrew, we're going to turn it over to some questions. So if there's any questions from the audience, we're happy to answer those.
We are indeed. Thank you, Belinda. Thank you, Stephen. What I did fail to mention at the beginning is please type in any questions that you have into your team's message, and we'll pick them up here and then relay them through to our two senior economists. Maybe just to reiterate, we've got 100% coverage pretty much now of the consumer space, consumer spending in the economy. We've aggregated that up into one composite index.
Correct.
And we've accelerated the release of that index to pretty much as close as we can to sort of real time following the month.
Yeah, that's right. So we're going to be publishing the index on the second Tuesday of every month. That's as fast as we can get it out. So it's really very timely data. Excellent.
So this should provide unique insights to key decision makers through the economy. First question, the October index suggests demand is strong, both on a monthly and year-on-year basis. Is it reasonable to assume that if this demand continues to grow and supply-side constraints remain in place, that a period of sustained inflation will materialise? Maybe, Stephen, I'll start with yourself.
Yeah, so that's the big question. And we can also see early in November that spending remains pretty solid. So I think the reopening is really going to see an increase in spending that's sustained, we think well into 2022. And yes, I think the premise of the question is correct. We do think that we'll get a build-up of some inflationary pressures next year. So our inflation forecasts have inflation moving up faster and more broadly than the Reserve Bank. So we have inflation back to the middle of the target range, around 2.5%, by the middle of next year, where the RBA is saying we won't get there till the end of 2023. So we do expect to see some inflationary pressures building through next year. Yeah.
A follow-on question, and it's home buying, very topical at the moment, right through all aspects of the economy. So what's your outlook? Are we likely to see a continued monthly reduction in home buying intentions given rates are forecast to rise sooner than previously expected?
Yeah, it's a good question. So I think there's multiple things going on there. So interest rate rises, and we can already see that being priced into markets. The other thing, of course, is APRA has raised the serviceability buffer, so from 2.5% to 3%. We don't think it has a big impact immediately, but you can see there's between rates and APRA's actions trying to slow the pace of home lending for individuals or the individual leverage. So this year, house prices they're already up 20% to the year to October. Our forecast for the whole year was 20%, so we're already there. We do have house prices rising by 7% in 2022. So still continuing to see increase in house prices, but at a much more modest rate. Clearly, if interest rates rose faster or APRA did more on the macro pru, that would have an impact on home lending. So it's not surprising to see a bit of a moderation in that pace of home buying index.
Yeah, understood.
Yeah.
Belinda, I might go throw the next question to yourself. Can you talk through the motor vehicle index in more detail? Why is the number for this October so much higher than last October?
That's a good question. So I think there are a number of moving parts with motor vehicle spending intentions. So the pandemic, we think, led to a lot of people changing their transport preferences. So the want for a second car. So public transport maybe wasn't being used as much. So we did see a lift in demand for cars, but also the wealth effect. So we know when house prices rise and wealth goes up, people generally are most likely to go buy another car or a new car as well. So the elasticity, if I can use a term like that, is stronger between wealth and cars than it is for any other item. So two main factors going on there that we've seen that motor vehicle spending intentions index lift.
It certainly lifts, it has. Now, Belinda, follow on. Did the results of this survey prompt any changes to your forecasts or views on the Australian economy? It's
a good question. So, I mean, many of our, regular watchers will know that we've heavily utilised our internal data to form our views on the Australian economy really throughout the pandemic. So not only the HSI, but our high frequency card spend data, the income that we see flowing through into CBA bank accounts. So over the last few weeks, we've been growing more upbeat on the prospects for growth in the Australian economy due to the reopening. The very high vaccination uptakes led us to upgrade our economic forecasts around 2.5 weeks ago. I think I've got that timing right. It might have actually been less than that. So we are now expecting a stronger recovery post-pandemic. That's also led us to think the RBA will lift rates earlier than what we had. So Stephen just talked about our views on inflation. So it's not only inflation coming through earlier, the labour market improving faster, consumer spending picking up, and that's certainly what we've seen in the HSI as well. So we think the outlook for the Australian economy is very good.
And maybe let's follow on to supply shortages, because that's a bit of a topic at the moment as well. And maybe, Stephen, I'll throw this to yourself. Have the supply shortages that have impacted motor vehicles had an impact on any other categories?
So they definitely impacted on motor vehicles. We can see that. More broadly in the economy, I'm getting a lot of feedback from businesses, particularly in the construction space, things like steel and wood and glass. So in the whether that's residential construction or commercial buildings, definitely there's some supply side concerns there. The agricultural sector, not specifically covered in the HSI, but getting a lot of feedback from businesses that the supply of things like tractors and the big harvesters, there's 12 to 18 month delays in getting big machinery in. So some of it's being picked up in the HSI, others in feedback we get from businesses and other data sets we see. So I think it's really quite a broad-based issue for much of the Australian economy, the supply side constraints, and that'll feed back into the inflation discussion we had as well.
And what about the supply of labour? Is there any evidence of wages starting to go up as a result?
So lots of talk about wages going up as a result. Not much in the official data as yet. We actually get our wages reading in the next couple of days for the third quarter. So we do expect wages to growth to accelerate through 2022 from about 1.7% now to closer to 3% by the end of next year. But again, the feedback from many of the businesses we talk to is that the two major problems they have is access to labour and the supply side constraints. So we would expect that to show up in the official data pretty soon.
Yeah, there's nothing more live than real-time conversations with business and customers themselves.
Absolutely, yeah.
Belinda, let's go to yourself. The index for utilities points to a steady rise since 2017. Is this a reflection of increased prices?
Be a reflection of increased demand. So just as the population gets bigger, more households, so not only increased prices that we've seen over that period of time, but also just the increased demand and use for utilities.
Understood. Can you offer some comments on the current battle between central banks and markets that seems to be playing out across the developed world? Maybe start with yourself, Stephen, if you can add anything.
This is a big theme in markets, and I think it will be next year. So everything we just talked about in inflation is what many people are seeing, and markets are pricing that in. And central banks look like they're deliberately pushing back against market expectations of early interest rate hikes. We've seen a number of central banks reduce or taper their quantitative easing program. The RBA, New Zealand, Canada, UK, US are all doing that. But in terms of actually lifting interest rates, it's really New Zealand that's only done that so far. Actually, other countries like Norway and South Korea. So it's interesting, it's kind of small open economies that are already lifting rates. The Bank of England kind of surprised everybody last week by not lifting interest rates, even though the governor had suggested that was coming. It is a bit of a battle, and I think our view certainly is that inflation's going to be a bit higher and more entrenched, not just in Australia but in other countries, UK, US, for example. So we do think central banks will be raising interest rates next year. We've got the Fed raising the Fed funds rate by June next year. We've got the Bank of England raising next year, Bank of Canada, more rate hikes from the RBNZ, and then Australia, November next year, we've got the first rate hike. So, eventually the central banks, we think, will come around to our view, and markets are trying to push them, pretty aggressively in that direction at the moment.
Yeah, I think at the height of this sell-off in our markets, I think it had probably 6 interest rate increases, by the end of next year.
Yeah, and starting in very early next year.
Yeah.
And I think the Reserve Bank's been pretty clear that they want to see inflation, sustainably inside the target range. And we think that means about 2.5%, so middle of the range, and at least for 2 quarters in a row. The RBA's forecast is that doesn't happen till the end of 2023. Our forecast is about a year earlier than that, so we've got the first rate hike in November 22.
Yeah. No, it became quite extreme, but it'll be a very interesting space to watch.
For sure.
Just to follow up on wages, what are the implications from borders reopening? What is the feedback you are getting from businesses?
So it's a really good question. It's still unclear as to how quickly borders will reopen. So we know Australians can travel, but we don't know when skilled migration, even education, can come back on. But we certainly hear from all clients, and I've done a lot of client presentations recently for our clients in WA, and they're kind of at they can't even get labour from other states at the moment. So they talk about really very strong demand for labour, but also wages. The feedback seems to be, and this is the RBA's viewpoint, is businesses are doing everything they can to get labour and hold on to labour without pushing up wages. So they are maybe giving bonuses, offering flexibility, rather than lifting wages. So I think businesses are trying to do that. The big question is how quickly borders reopen. What does the skilled migration program look like? Will it go back to what did we have in 2019? And will that start to dampen the prospect of any wages growth we have? So it's a bit of it's an unknown at the moment. The labour market is tight. We've seen very strong job vacancies, and they haven't dropped too much during the pandemic. If you just even look at rehiring plans on the reopening, they're very strong. You can walk down any street at the moment. All restaurants have for help signs, staff wanted signs. So it will be interesting to see, and particularly for the RBA's outlook, if we can generate that wages pressure before we see borders reopening, or particularly will the RBA lift rates if they get inflation where they want it, but they don't get wages where they want it. And I think, this is a question we've been grappling with because it is unknown on the borders. I think we're going to have to generate that wages growth here, regardless of what's happening on the borders, but will we get it? It will be really interesting to see.
One would hope we're closer to the borders opening.
Yeah. I think it's interesting that when you think about labour and the borders, you've got the skilled labour force, visas and so technology and professionals. Then you've got the foreign students who quite often work in the hospitality industry, so there's not many of those. And then you've got the the tourists, the backpackers. Particularly and things like the agricultural sector where that's been affected. So it's right across the skill set, different parts of the economy. We've run this experiment really for 18 months, 2 years, where we've had significantly less population growth than we've been used to. And it looks like what it's doing is forcing down the unemployment rate and forcing up wages growth, which I think a lot of people think that's a pretty good combination. But businesses certainly are telling us they want to see those borders reopen pretty quickly to get that labour back in. So that's going to be a really key theme for 2022, wrapped up with the inflation story, wrapped up with the central bank monetary policy story. So I think
but importantly, we're continuing to invest in critical infrastructure as well, which has a good multiplier effect through the economy that will be able to cater for increased population growth when those borders do open, I'm assuming.
I think the big infrastructure projects are really important in a number of ways. So they create a lot of jobs now, and we can see in the capital cities, particularly here in Sydney, there's a lot going on. But they also improve productivity in the future. So once the projects are done and you can move people and goods and businesses and services around the city in a much more efficient way, they really improve productivity. So they're great for the immediate term and for the long term as well. So I think that'll be a key feature of the budgets for quite a number of years.
I would agree. Yeah. And look, there are no more questions coming from the audience. So with that, Stephen, Belinda, any final comments around the index that you'd like to say?
Well, I think just the fact that it's a really comprehensive data set, very large data set, really quick, and we can see that spending right across the economy, and then we can narrow it down to that single index. I think it's going to be a really valuable addition to the data available for Australian businesses, for investors, for policymakers, for the media. So we're really excited about launching it today and letting it build as the years go by.
Yeah, absolutely. I'm very, very excited about the Commonwealth Bank's data and analytics capabilities being applied to such an important purpose, for helping provide critical insights into the economy, which are going to be so important for the recovery and transition going forward. So thank you for all of the hard work that you've both done in your teams, and thank you for everybody that has dialed in today to hear this launch, and we look forward to working with all of you in the months to come as we release more iterations of the index. Thank you very much.